to preciousmetalsinvesting.com. If you're watching this video from the website, if you're listening to this podcast, welcome to the Precious Metals Investing Podcast. It's also available now on iTunes and also on Google Play. And I'd also like to welcome our guest today, Paul Majanovic. Paul is the author of Precious Metals Investing for Dummies. He also has a new book out, High Level Investing for Dummies. Welcome, Paul.
Well, I'm glad to be back, Ted. And you know, it's interesting, in recent sessions, there's been some strength showing in the bond market. To a great extent, a lot of the people who are worried about the turbulence and uncertainty in the stock market have been moving money to bonds. And the thing is that over the last, 40, 50, 60 years, there's always been, in terms of normal markets, whenever, bonds are considered a safer bet for your money than stocks, for matter. Why is that? Well, if you have a company, for example, that's a public company, has stock, and let's say they have bonds, the point is that in the worst case scenario, if a company goes under, the people who get paid first are the bondholders before the stockholders. And there's even a hierarchy there. Preferred stockholders get paid before common stockholders, etc. So in that extreme example, you get an idea about why people move money to whatever point there is. So historically, bonds do well, like in recessions, for example, because people understand that those companies will be paying those bonds, whether the economy is doing well or not, and that's going to have a preference in terms of their cash flow to pay it so that they can meet their financial obligations and legal obligations, and that's been true for years. And of course, what people have done in recent years is moving a lot of their money into riskier bonds because interest rates have been at historical lows and even getting lower. To a great extent, there was people who made a lot of money in recent years putting their money into things, not only regular bonds, but junk bonds as well, where they got like interest rates. Because whenever interest rates are very low on things like your savings and regular quality bonds, many people, that kind of forces people to try to seek money elsewhere, and including people who rely on interest income, like many people who are senior citizens. So this is why I don't like the way they're managing, at the macro level, interest rates, because there's that perverse incentive in place. You can have money going to riskier venues to seek higher yield because they don't want to be punished by the low yields in their existing investments. So money's been moving to bonds, and I think that in the short term, that's probably a great, maybe short-term place to have some of the money, especially if they're talking about AAA bonds, or the Treasury bonds, which tend to be safer relatively than the rest of them. But the interesting thing is that we're heading into, epic bear market times and epic bubbles, and I think people like Michael Pinto have done an excellent job with detailing this bond market bubble and why that's one of the most dangerous in financial history.
And I think as we've discussed, there are lots of reasons to be concerned about the bond market. And I was thinking it's sort of the reverse of the old saying. In this case, you're jumping out of the fire into the frying pan.
Yeah. So in the short term, the bonds have held up well because if interest rates are coming down, that's boosted the value of fixed interest rate venues such as some long-term bonds as well. So there's some strength there in the short term. But the point is, will it still be the way it's been the last 40, 50 years in this venue where that's been relatively a safe haven, quote unquote, for stock investors is the bond market. But what happens the next 6, 12, 18 months when now the worldwide debt starts to tear apart the seams, and all of a sudden even quality bonds start to have major issues, and you start seeing defaults and such. So this is why, to a great extent, people turn to precious metals and also places where it might be like I like savings bonds too, that are issued by the Treasury. At least I can take those in after a year and get my money out. It's guaranteed by the federal government. I'm not locked in forever. And people, and by the way, interest rate accounts like savings, yes, you'll get next to nothing, and God forbid if negative interest rates hit, you might end up moving your money out of there as well. But more and more, like wherever you look out there, all roads lead back to where is their quality, where is their reduced counterparty risk, and part of that selection process is going to be precious metals. So be careful with the bonds that you're into out there. Take a look at the bond rating. Make sure that the issuers themselves are not having financial issues. But you're going to start seeing defaults and a lot of other negative impacts happening as the great bond market bubble is start tearing apart the seam over the next 6, 12, 18 months. So again, be more diversified than ever before and be more of a hawk in where your money is for now.
Well, Paul, thank you for being with us today at preciousmetalsinvesting.com. Make sure you get a copy of Paul's new book, High Level Investing for Dummies, and make sure you go over to iTunes, subscribe to the Precious Metals Investing Podcast.